I want to tell you something that nobody on television is saying out loud. Not the analysts, not the anchors, not the economists in their press suits sitting behind polished desks. They are not lying to you. That is the important part. They are not lying. They are simply telling you the story that keeps the music playing. And the music right now is very, very loud. I know because I have heard this song before. I heard it in 1929. I heard it in 1999. I heard it in 2007. And every single time, the people who were dancing the hardest were the ones who lost the most when the music stopped. Right now, in February of 2026, I am hearing that song again, and I am going to teach you exactly what I hear, because what I hear is not enthusiasm. What I hear is the silence that comes just before the fall. I call this the silence before the fall. Most of you watching this right now have no idea it has already begun. That is what I am here to change. Let me start with the way a teacher starts. Not with a prediction, not with a panic, with a question. What does it mean when the richest man in the world is sitting on $380 billion in cash and refusing to buy? Think about that carefully. I have money that most countries do not have in their national reserves. I have access to deals that no retail investor will ever see. I have relationships with every major CEO, every major bank, every major financial institution on this planet, and I am choosing to sit still. I am choosing to hold treasury bills earning 3.6% per year instead of deploying that capital into the greatest stock market in American history. Why? That is the question. And the answer to that question is the most important financial lesson you will learn this year. It is not fear. It is not confusion. It is math. Pure, unforgiving, historically proven math. And the math is telling me something that most people are not disciplined enough to hear. There is a number I have spoken about publicly for more than 2 decades. I first wrote about it in Fortune magazine in the year 2001. At the time, the market had just begun its collapse from the dot-com bubble. People were shocked. I was not shocked, because the number had warned me years earlier. This number is simple. It takes the total market capitalization of all publicly traded companies in the United States, every stock, every share, every dollar of equity on every exchange, and it divides it by the gross domestic product of the United States. It tells you how much the market thinks the economy is worth compared to what the economy is actually producing. When that ratio is between 75 and 100%, the market is reasonably priced. When it climbs above 150%, I start paying attention. When it breaks 200%, I start moving money. Right now, as of this month, that ratio stands at 224%. 224%. That is not a record for a single year. That is the highest reading this indicator has ever recorded in the entire history of American financial markets. Higher than 1929. Higher than the peak of the dot-com mania in 1999. Higher than the housing bubble in 2007. And the music is still playing. The headlines still say buy. The analysts are still raising their price targets. And most of you are still dancing. I want to explain to you why most people miss moments like this. I want to explain it the way I would explain it to a young student sitting across from me in Omaha. The human mind is extraordinarily good at one thing: finding patterns that confirm what it already wants to believe. Psychologists call this confirmation bias. I call it the most expensive instinct in the history of personal finance. Right now, the pattern most investors see is this: markets have gone up for years. Artificial intelligence is real and transformative. Corporate earnings have been strong, and unemployment is low. They see that pattern and their brain tells them, this is good, stay invested, buy more. And every single part of that pattern is factually accurate. That is what makes this moment so dangerous. The danger is not in the lie. The danger is in the incomplete truth. Because what that pattern does not tell you is the price you are paying for it. And in investing, the price you pay for something determines everything. Let me teach you about what I call the euphoria tax. Every single financial bubble in American history has been built on a real story. In 1929, the story was industrialization. America was becoming a manufacturing superpower, and the world was going to need American steel, American railroads, American radio. That story was true. And yet between 1929 and 1932, the Dow Jones Industrial Average lost 89% of its value. 89%. People who had invested their savings, their farms, their futures into a true story lost nearly everything. Why? because they confuse the truth of the story with the fairness of the price. In 1999, the story was the internet, and I will tell you something candidly. The internet did change everything. Every prediction the bulls made about the internet eventually came true, and yet the Nasdaq lost 78% of its value between 2000 and 2002. Because truth and valuation are two different things entirely. Right now, the story is artificial intelligence. And I am not dismissing that story. Artificial intelligence is real. It will reshape industries. It will create enormous wealth for some. But right now, the market is pricing in a future of perfect, uninterrupted, compounding AI-driven earnings growth forever. No recessions, no competitive threats, no regulatory friction, no geopolitical disruption, just endless growth, priced in today, paid for by you. That is the euphoria tax. You are paying today for a tomorrow the market has already promised you, and history has never once honored that kind of promise without eventually sending the bill. Now I want to teach you about what I call the AI mirage. When I reduced my Apple position from approximately $200 billion to roughly $60 billion over the past 18 months, people asked me why. They were puzzled. Apple is a magnificent business. I know that. I have watched Apple for decades. But a magnificent business purchased at twice its fair value is not a magnificent investment. It is an expensive wish. The Shiller-Cape ratio, which measures stock prices against average inflation-adjusted earnings over a full decade, currently sits near 40. The historical average of that ratio going back over a century is approximately 17. That means you are paying more than double the historical norm for every single dollar of earnings in this market. Robert Shiller at Yale University, who won the Nobel Prize in Economics in 2013, in part because of this research, demonstrated with decades of data that when the Cape climbs this high, subsequent 10-year equity returns are historically poor. Not catastrophically negative, but poor, barely keeping pace with inflation in most historical cases. You are not investing in growth at these prices. You are investing in hope. And I have been in this business long enough to know that hope is the most expensive asset class of all. The AI mirage is the belief that because the technology is transformative, the math does not matter anymore. The math always matters. The math always wins. Always. Let me show you something that most retail investors never think to look at. I call it the concentration trap. Right now, the top 10 companies in the S&P 500, just 10 companies out of 500, represent approximately 35% of the entire index's total value. Think about what that means. If you own an S&P 500 index fund, you believe you are diversified. You believe you own 500 companies. But in reality, 35 cents of every dollar you invest is sitting in 10 names. 10 companies in technology, artificial intelligence, and consumer electronics. And 3 of those 10 companies have recently reported earnings that disappointed their most optimistic forecasts. That is not a small thing. When 35% of a market index is load-bearing on the same story, the AI story, the tech story, and that story begins to crack, the index does not decline gradually. It collapses at the weakest point. This is not theoretical. In 1929, the market was similarly concentrated in railroads, steel, and the radio industry. When those 3 sectors broke, the entire market broke with them. In 1999, it was technology stocks carrying the weight of a bull market. When the 10 largest tech companies started reporting disappointing growth, the Nasdaq did not fall 10%. It fell 78% over 2 years. The concentration trap is not about picking bad stocks. It is about the architecture of a fall. And right now, the architecture of this market is more concentrated, more dependent on a single narrative than at almost any other point in modern history. Now, I need to tell you about the smart money exit, and I want to say this plainly, because plain speaking is the only kind that matters in moments like this. I am not the only large investor who has been quietly repositioning. Over the past 12 months, corporate insider selling, the selling done by CEOs, CFOs, and board members of publicly traded companies, has accelerated significantly across the United States markets. These are not panicked investors. These are the men and women who built the companies you are buying shares in. They know the earnings forecasts. They know the internal projections. They know whether the story the market believes matches the reality the company is living, and they are selling, quietly, carefully, without press releases or television appearances. The smart money exit does not announce itself. It does not give retail investors advance warning. By the time the exit shows up in headlines, the exit is already finished. I have famously said that my secretary pays a higher effective tax rate than I do. When I said that, I was not bragging. I was confessing. I was confessing that the system is built to protect capital and burden labor. Right now, that same system is offering me 3.6% annually on United States Treasury bills, guaranteed, backed by the full faith and credit of the American government, while asking me to pay 35 to 40 times earnings for equity in companies whose growth assumptions I find difficult to justify, even in the most optimistic scenario. I am choosing the guaranteed return, not because I am pessimistic, because I am a mathematician, and the mathematics is not close. I want to address something directly because I know some of you are thinking it right now. You are thinking, Warren, you have said this before. You reduced your Apple position and the market went up. You held cash in 2023 and the S&P returned over 24%. You have been cautious before, and caution cost people money. You are right to raise that, and here is my honest answer. I am not in the business of timing markets. I never have been. I am in the business of understanding value and waiting for the price to match it. The market can remain irrational longer than any single investor can remain solvent. John Maynard Keynes said that, and he was right. But here is what I want you to understand. The danger is not that the market falls tomorrow. The danger is that you are fully invested, carrying debt, without a cash buffer, without a plan, and without the temperament to hold through a 30 to 40% decline without selling at the exact worst moment. Most people who lost generational wealth in 2001 and 2008 were not ruined by the crash itself. They were ruined by their own panic at the bottom. They sold at the lowest point, locked in the maximum loss, and then watched markets recover without them. The market recovered. They did not. That is the liquidity illusion, the belief that because you can sell at any moment, you are protected. Liquidity is abundant when prices are rising. It evaporates the moment everyone tries to use it at once. In 1987, the Dow Jones lost 22% in a single trading day, not a week, a single day. The people who believed they could exit quickly were wrong. There was no exit. There was only the fall. So let me tell you what I believe you should be doing right now. Not because I am predicting a specific date, a specific number, a specific catalyst. I am not doing that. I am not capable of doing that, and neither is anyone else. What I am capable of is reading the architecture of a market and telling you whether the foundation is sound or whether it is built on assumptions that history has never once validated. The foundation right now is not sound. That does not mean you sell everything tomorrow morning. It means you think carefully about how much of your financial life depends on this market continuing to rise forever. It means you ask yourself whether you have a genuine cash reserve, not just a checking account, but a meaningful allocation of liquid, low-risk assets that you could live on for 12 to 24 months without touching a single equity position. It means you look honestly at your debt, because in a declining market, debt does not wait for recovery. Debt is patient in a different direction. And it means you think about concentration. If 80% of your net worth is in a single asset class, a single sector, a single story, you are not an investor. You are a speculator. And the market in 2026 is not forgiving enough to let speculations go unpunished forever. I want to end the way I always end, with time. Because time is the one thing that no number on a balance sheet can replace. I want you to imagine that you are 82 years old. You are sitting somewhere quiet. You cannot move markets anymore. You cannot work overtime to recover what was lost. You look back at this specific moment, February 2026, when the Buffett indicator stood at 224%, when the smart money was quietly exiting, when institutional analysts at Goldman Sachs and Capital Economics were issuing careful, measured, rarely covered warnings about double-digit market declines. And you ask yourself the most important financial question you will ever ask. Not, what did the market do? But, what did I do with what I knew? Did I dismiss the numbers because the music was too comfortable to leave? Did I stay in the dance because everyone else was still dancing? Or did I do the hard, unglamorous, deeply unpopular thing? Build my reserves, reduce my leverage, examine my assumptions, and prepare with the quiet discipline of someone who has read enough history to respect what it says. I cannot give you time back. I have more money than I will ever spend, but I cannot buy back a single decision made in a moment of willful blindness. I cannot go back to 1999 and hold the hand of the families who put their retirement savings into dot-com stocks because the story was too exciting to question. I cannot undo the damage that 2008 did to a generation of homeowners who believed that prices only ever went up. All I can do is stand here, in this particular moment, and tell you that the numbers are speaking. The indicators are speaking. History is speaking. The question is not whether you will listen. The question is whether you will listen now, before the fall, or later, after it. The door to the cage is open. It has always been open. The cage, in this case, is not made of poverty or circumstance. It is made of comfort. It is made of the story you want to be true. It is made of the quiet, powerful human instinct to believe that because nothing terrible has happened yet, nothing terrible will happen. That instinct has ruined more families, more retirements, more futures than any market crash ever did. The crash is not the disaster. The unpreparedness is the disaster. And unpreparedness is always a choice. You have today. You have right now. You can choose to keep dancing, or you can choose to prepare. Not with fear, with clarity, with the cold, respectful acknowledgement that the mathematics of 224% have never in the entire history of American markets resolved themselves quietly or gently. They have always resolved themselves loudly, painfully, and exactly when the most people had the most to lose. That is all. Thanks for watching.